Hey everyone, my name is the Smart Money Technician and welcome to another video. First things first, I just want to wish everyone a happy new year. Hopefully you achieve your goals, your dreams and your aspirations this year. And this year is going to be a year that I will be releasing a lot of content, right? But in this video, let's get into the video without much fuss. In this video, we are going to be discussing the protocol that you follow when trading a lower probability trading week. Now, before I even get into this video, I just want you to know that there are many of these trading weeks that are low probability. The idea that is put out there that you're always going to be winning and the market is mostly high probability is simply not true, okay? So to be able to come out of these weeks unscathed, you need to know that, number one, you need to not take that many trades because many of the trading days are going to be low probability and it's going to feel like this just doesn't make sense. And the mindset that is put out there, unfortunately, is that we're trading smart money. We're trading with the banks. We're always right. Okay? And that is simply not the case at all. The mindset that you should have gone into this is that, number one, I am trading. When I am trading, that is, I am going to be profitable even if I have a low win rate. That is literally the foundation to profitability. There is no reason that if you ended the month in just a 40% win rate, that you should end that month in a deficit, in drawdown. Nothing wrong with drawdown, but your profitability should be taking place. You should still be profitable even if you have a low win rate. If you can put this as the foundation to your trading, it is going to be very, very, very easy to be profitable. So let's get into the video. Let's not waste any more time. And as you can see, we are on the charts. We start our analysis on the weekly time frame. Now, right off the bat, you can see that we are at all-time highs. We've recently just reached that within this trading week, right? So first thing that you need to know about a all-time highs market is that if you're going to get any sells inside of here, it generally is going to be low probability because there is no higher time frame key level that is supporting price in why it should sell. Usually what happens is that, let's say price was down here and price was at a gap and gave a sequential SMT on the lower time frame, at least we have a key level saying that price should sell. But inside over here, there is no key level. So the sequential SMTs or the TPDs that happen inside of here, the cracking correlations that happen inside of here are generally low probability. It doesn't mean it can't work. It just means that there's a chance that it won't really work. So the best case scenario that we usually follow in all-time high markets is to be bullish till proven wrong otherwise. However, if I did see a sell inside of here, it doesn't mean I won't take it because I don't care about losing. I know that eventually I'm going to win a trade, but you just have to take it with a grain of salt. So you can't be over trading in this kind of market, especially if you're selling, right? Another thing that we can see over here is that price traded down into this gap that is so small, right? Gaps that are small generally aren't too high probability, but it respected it and closed above it. So we are at a point of contention because over here we have a TPD and price did trade lower with the TPD, but then it traded into this gap that is small and respected it. So we have a lot of things that are pointing upwards or downwards in the market. So we don't have a clear direction. Okay, so when this happens, you know immediately that we are in a low probability environment. We don't have a clear read on price. Therefore, we need to allow the week to play out, to tip its hand to us so that we can be able to navigate the week properly and avoid any unnecessary losses. In other words, you need to wait for the high or the low of the market to form and to be confirmed that that is the high or low of the market before you even start trading, okay? All right, so we are in the section of the economic calendar, and you know that we use the economic calendar to map out what the week is likely to do, right? So as you can see, on Monday, it is a bank holiday. We're also at all-time high market, so probably don't want to trade on this day. Tuesday, the day after a bank holiday, is another day that you want to avoid because the entries tend to not be very precise and the market tends to not really respect the sequential SMTs that much, although it could win, but there is a chance that it's not going to be so high probability. Only on a Wednesday, right? That's where the first red news folder comes out, and that is FOMC meeting minutes. This is not the actual FOMC. This is the meeting minutes. And anytime this FOMC comes out in the PM session, the morning session tends to not be that high probability, and the real move most likely will come during the PM session. Although I don't really trade the PM session, this is one of those days where you can trade the PM session if the cracking correlation presents itself during that session, okay? Thursday has the most red news folders. So what I then say, right, what I will say is that this is going to be the most significant day in the trading week. So the high or the low of the week will form on this day or the day before. You see, so you always take the day that has the most news folders or the most significant news coming out that day, and then you say that day or the day before. Okay, so that is where likely the week is going to form. And on Friday, there's not really news. I don't really ever trade Fridays because Fridays generally are always low probability, especially if you're trading in terms of your bias. If you're a trader that does not counter trend trade and you only trade in line with your bias, Friday is not a day that you want to do that, because Friday tends to form the opposite end of the weekly range. Meaning that, let's say you were bearish this week and you sold the entire week, on a Friday you don't want to sell because Friday is likely to bounce that day and form the low of the week, right? Therefore, it's not really advisable to trade your bias on that particular day. Okay, so this is the economic calendar, and we'll get to the next session. All right, so right now we are on the 6-hour time frame. And remember, we don't really know or are certain which direction that the market could possibly move into. So going into this day is not so clear for us, right? So the first thing we want to do is to allow Monday to play out. Monday, on days like this, are usually used as a day that you forecast. Monday allows you to see what the market is going to do so that you can try to predict what future price action can hold, right? So we're going to be on the 6-hour time frame, right? And we will allow Monday to play out, right? Okay, so this is the 6-hour time frame, and the Asia candle, the London candle, the New York candle, and then the PM session candle. As you can see, Monday did not really do anything, and that is expected, especially with the way the economic calendar was looking, right? So the next thing that we are going to do is that since Monday did not do anything, we can then safely say that if Monday was a consolidation, it cannot be the low of the week. Think back in time and ask yourself, when have you ever seen a consolidation being the low of the week? It's highly unlikely, right? So we are going to wait for more information. Therefore, we are only going to engage once we are certain that the low of the week has formed or is about to form, and nothing has shown in price for us to be fully aware that the low of the week has yet formed. So we will allow Tuesday to play out and see if it tips its hand. So as you can see on Tuesday during the Asia session, we immediately rally into this we immediately trade down into this high time frame gap on the Dow Jones, right? And we're going to watch how price reacts around it. So as you can see, what has happened is that over here in the gap, it seems that we are respecting the gap, right? Now, in the other assets, we are also giving a sequential SMT on the monthly cycle. So we've taken out the low of the previous week, while here we failed to take it out. And another thing that you can do to qualify your sequential SMTs, especially when it is a higher time frame sequential SMT like the monthly cycle, is that you need to check whether it is in sync with premium and discount. So what does this mean? In this asset, which is NASDAQ, you can see that we took out the low of the previous quarter. The asset that does this, the asset that makes the turtle soup is what we call it. The asset that makes the turtle soup, we will refer to this as being in deep discount because we're looking for a potential buy. You always want to buy in discount, right? So this asset is considered as an asset that is a discount. And then you look at the asset that is making a failure swing, which is over here, S&P 500, and you take your fib from the low of the previous quarter up to the high that price is currently retracing from, right? And as you can see, from to the side, price has retraced to the 50% and even below. So if price gets to at least the 50% or below, we will say that it is also in discount. Therefore, this is in discount, this is in deep discount. These two are in sync with one another, right? So that is a good thing that we want to see, and that is what qualifies this SMT as a valid sequential SMT. Now, if you do the same for Dow Jones, which also made a failure swing from the low right up to the high that price is currently retracing from, you can see that price does not get into discount. It does not reach the 50% or below. This means that Dow Jones is not in sync with ES and NASDAQ. So it is decoupled. And what that means is that any crack in correlation, whilst Dow Jones is currently not synced with these two, is not going to be taken into consideration, right? So we will ignore any crack in correlations here until Dow Jones at least gets back in sync with these two. This is just a tool that you can use to qualify your SMTs. All right, so let's continue. So we have this, and we have reached the end of Tuesday forming this SMT. This means that going into Wednesday, we are going to look for some kind of crack in correlation that is going to confirm this SMT for price riding high. You see, when you see an SMT like this, you don't just immediately buy. You need a confirmation. Had the Dow Jones been in sync, if you look closely over there, this candle right here was a TPD. It could have confirmed that. But because it is not in sync with these two, we are not going to consider it at all, and we need another confirmation, right? So today we're going to start the day on the 6 hour, as our protocol says. Asia session, London sessions candle, and you can see the London sessions candle is not a TPD. We go to the 4 hour time frame. Now on the 4 hour time frame, we want to check if the 4 hour 2 a.m. candle is a TPD, and you can see it's not a TPD. Now, also going into this very day, you should know that FOMC meeting minutes is coming out in the afternoon session. When FOMC meeting minutes comes out in the afternoon session, what that does is that it causes the AM session to be low probability and the price action to not be that clear. Coupled with the fact that we recently reached all-time high markets, now the session is really going to be not so high probability. So if you did trade and you are the kind of person that re-enters, it is best to avoid doing something like that, because you don't want to maximize the effect of a losing period or a low probability period, right? So nothing on the 2 a.m. candle. We go to the 1 hour. On the 1 hour time frame, we're concerned with the 7 a.m., 8 a.m., the 9 a.m., and the 10 a.m. 1 hour candles, if they will give us a TPD. So I'll fast forward to the 7 a.m. And as you can see, the 7 a.m. is not a TPD, so I go down to the 15 minutes, because starting from 8:30, right up to 9:45, an M15 TPD might form within one of those candles. So I'm going to be cycling from the 1 hour and the 15-minute candles to check if each candle forms a TPD, right? So 15 minutes, we'll go to the 8:30 candle. As you can see, the 8:30 candle is not. Check the 9:45 candle. And the 9:45 candle looks like it is a TPD. However, it is a TPD that is forming in a premium, and the price swing over here, right, that causes the price to move higher is not a tracking correlation. Therefore, this is not a valid TPD to consider. You would have to see some kind of maybe 90-minute cycle sequential SMT, then price expands and it forms this kind of TPD, and it can be used as a TPD for a continuation. But that is not what happened over here, so we are going to ignore this TPD, as I said in the previous video. So this is not something that is new, right? So we will go back to the 1 hour, but also check this over here. Right here, what we have is a sequential SMT on the day cycle, right? However, we want to really wait because there is no news in the AM session, right? So you want to wait for the 9:30 candle to really open to see what happens, and if this will cause price to expand upwards, and then you can be able to enter, because it is not generally high probability to enter ahead of 9:30, especially when there is no news in the AM session. So we are just going to mark this and keep in mind what is going on, and then we are going to watch and note if it causes any kind of expansion. So we're just going to wait. We're not going to run into the trade immediately. You don't want to be impulsive. We'll just mark this and watch how it reacts, right? So we'll go back to the 1 hour to check. The 1 hour candle, the 8 a.m. is not a TPD. We go back to the M15 and we continue. 9 a.m. candle, nothing. 9:15 seems to be retracing. It's not showing any signs of going higher. And then 9:30, and you can see that. So had you entered ahead of the 9:30 candle, you could have incurred an unnecessary loss. Again, keep in mind, on days that there are not news, it is best to wait for 9:30. Now, 9:30 has come out, right? And you can see this candle. It has taken out the low over here, which is the low of Q2 of the 90-minute cycles. While over here, it has not taken out the low of the 90-minute cycles. So if we go to the 5-minute time frame to look at the 90-minute cycles correctly, we can see the SMT over here with below the London lows, below the true day open as well, right? And we can see that there is a sequential SMT taking place currently. Now, a quick crash course on sequential SMT, especially when you are on the lower time frame cycles. Anytime I am bullish and I'm expecting higher prices and I see sequential SMT or regular sequential SMT, is when this asset that took out the low is known as the asset that is turtle souping it. The asset that turtle soups the low, right, closes below that low, okay? So once I see something like that immediately, the first thing that I want to do, right, is that I want to enter a limit order. So I take the asset that making the failure swing, as that is the asset that has the best opportunity of trading in my direction. So from the low right up to the high that price is retracing from, and I initially place my entry on the 70.5 level, right? Now, sometimes price will not reach the 70.5 level, but it will trade into the 50 or the 62 and give a change in the state of delivery. And I'll enter based off that and put my stop loss below the change of the state of delivery. However, my main focus is the 70.5 level, and I put a limit order there, right? And then I put the stop loss just at the low or slightly below it, just in case price may come extremely close, especially that the session is expected to be very low probability. So I don't want to be prematurely stopped out of the trade. If I'm stopped out of the trade is completely invalid, and this low of the previous quarter was completely taken out. So we don't want to leave any room for unnecessary error. This is not a time to be focusing on precision, right? So as you can see over there, we'll just put a code over there, and then we'll see what happens with price. We'll trade it in. Price gets extremely close to the low, but it's not completely taken out. So the setup is not invalidated. I'll just place the stop and take profit 1:3. We'll confirm, and then we'll see what happens, right? As you can see, price completely takes out the high, right? So take profit has been hit, right? Now, the next thing that we can say is that price came so close to the low and was expected that the session was going to be really low probability, but you could have been lucky and come out with a 1:3 risk to reward. Now, I want to show you guys something, right? To show you just how low probability this period that we're trading in. So what we're going to do is we'll go back to the M15, right? We'll take this out of the way, just so that there's not much confusion. And as you can see, price on the Dow Jones have finally reached the 50%, meaning that it is now in sync with ES and NQ, right? So it is now currently in sync with the two of them, all right? So what has happened is that over here, and also, by the way, right, remember when we had the sequential SMT between NASDAQ and the Dow Jones, right, where they took out the low of the London session, but it did not do so in the Dow Jones. The reason why that failed is because, remember I said that it was not in sync with the 12, and so using the Dow Jones to get any kind of traffic correlation is going to be low probability. Coupled with the fact that there was also no news in the session, this is why the spike down happened and that daily cycle sequential SMT really failed, okay? I hope this is making sense. So these are the little things that you need to keep in mind when you're trading. Now, what we're going to do is we're going to continue to play the session and see what happens, because a 90-minute cycle sequential SMT did not really cause price to explode much, so we can't fully be certain that the low of the week has formed yet. So we're going to watch what happens when the news for the FOMC meeting minutes comes out during the PM session. We're about to enter into the PM session soon. When the PM session, right, and on 12 it goes down, and I'm going to place a cursor by 2 o'clock so that you can see when that news comes out. And as you can see, ahead of the news, we're having a sequential SMT taking place, right? However, we've already gotten our trade for the day, so there's no need to enter. And PM session really is low probability. But what we will do is we'll just watch it to see if it causes some kind of expansion with a fair value gap and a breaker. That is the highest probability style of entry, especially in low probability markets. So we want to see what happens. So as you can see, price is spiking down. It eventually takes out the low, invalidating the sequential SMT that was on the daily cycle, right? So the only possible thing that can happen now that we're below the low of the New York session in both assets, in all three assets, is that the next thing to do is to watch the 90-minute cycles to see what happens, right? And as you can see, we get a 90-minute cycle sequential SMT. Now we want to see, does it give a confirmation? As you can see, over here we do have a precision swing point / a TPD, which is confirming this SMT. But if you want further confirmation, you can see that price breaks structure to the upside, right? It breaks structure to the upside, giving us a breaker and a fair value gap, right? So if you did not trade the AM session, this would have been the high probability trade for this particular day. So we're going to see if this price return back to this gap that is in line with the nice break over here. So let's see what happens, right? It really is expanding by much. And you can see it returns back right to this level before it even expands even higher. And here it doesn't do that, okay? So this would have been the high probability trade for the PM session. And this is the one that really causes the market to expand. And the way that we have confirmation with something like this is we go to the 4-hour time frame and we see, does this lead to the formation of 4-hour gaps, right? A 4-hour fair value gap. So let's see, does Wednesday form a 4-hour fair value gap, which I believe that it will. As you can see, it has formed a nice 4-hour fair value gap. So a nice displacement reacting off the SMT that is in place, leading to 4-hour fair value gaps. We have a good confirmation that this low formed on Wednesday is indeed the low of the week, right? Especially in ES and NASDAQ, because they've really reacted off that level, right? So going into the next day, we have a full-on confirmation that the market has turned, the low of the week is in play, and we can be bullish going into the next trading day, right? So when we see something like this, the first thing you do is you mark the 4-hour fair value gap, right? On ES and NASDAQ. Right, so you mark the 4-hour fair value gap that is on them, and if price returns back into them, because we do have a trading model where price is going to return back into the previous day's 4-hour fair value gap, a gap that forms on Monday, Tuesday, or Wednesday. And today is Wednesday. We have confirmation that this is the low of the week because of the larger monthly cycle SMT, and it leads to this. So if price does trade into here, we will have a short-term trade. However, we're also going to watch the lower time frame cycles. If price is going to give an SMT that is bullish, and price will trade higher, so it might return into this level, or it might just give a cracking correlation on the lower time frame cycles and expand higher. So going into the next day, that's what we're going to do. So we're going to watch the 6-hour candle first of all on the 6-hour time frame. On the 6-hour time frame, that's the midnight candle, and it's not a TPD. Go to the 4-hour. You can see that the 2 a.m. 4-hour candle is not a TPD. We're now focusing on the 1 hour, and we are primarily focusing on the 8 a.m., 9 a.m., and 10 a.m. candles for the 1 hour. 7 a.m. candle is not it is a TPD, but it's a TPD that is in a premium, so we are going to take that with a grain of salt. If it can be confirmed with a sequential SMT, then that is a good thing, but for now, we're not really too concerned about that. 15-minute. The 8:30 is not a TPD. The 8:45 is not a TPD. Now I want to point something out over here. Can you see that over here on the 90-minute cycles, you have this low right there, this low that is right here, and here during Q2, we have an SMT that has taken place. Now, let me tell you something very important. SMT on the 90-minute cycles that happens between Q1 and Q2 is low probability. I usually ignore this SMT because I know that 9:30 usually takes it out. It rarely ever works out. So this SMT is an SMT I usually ignore. I don't really pay attention to it. So I would advise you to always ignore Q1 and Q2 SMT. You can go practice it for yourself. It's not that high probability. It doesn't really work out much times. Very few times does it work. And if it does work out and really expands, during Q3, you can be able to catch a breaker and a fair value gap entry to capitalize on it. But it just being here by itself is not enough of a confirmation just yet. So we'll go back to the 1 hour, check out the 8 a.m. candle. 8 a.m. candle is not a TPD. We go back to the 15-minute. As you can see, price immediately comes back on the Dow Jones, taking out the low of Q2 during Q3. And over here, you can see we're failing to do so. So something like this is something that is worth taking note of, right? So we're going to be in here, right? And we're going to be on the 5-minute time frame. I'm going to watch what happens, right? So I'm going to watch this price also close below this low. From the low of Q2 to Q3, and we're retracing. If price does at least close below the low of this wick, right, then we will be focusing on the 70.5 levels to see if we can at least get price to give us an entry there. Price is going. It has closed below the low, right? And as you can see over here, the Dow Jones is making a failure swing. That means we are primarily going to be focused on ES as the asset that we could potentially trade. And you can see that we did not reach the 70.5 level. We rather gave a change in the state of delivery, right? So because we got that change in the state of delivery happening, we will focus on the ES. Stop loss below the low. Entry. And the 9:30 is about to come out, so it might really spike below the low, but we want to just see what happens. Price instantly spikes below the low, but Dow Jones does not yet take out the low over there. So a person, what you can do is that you can wait to see if there's another entry that is going to be presented, right? We're watching. You can see that there's a change in the state of delivery in NASDAQ, and S&P has not given that change in state of delivery, but the only thing that would make you re-enter this trade is if you get a break and a fair value gap. And as you can see, price takes out this low. You can see this high, low, higher high. We're going to watch this level to see if it gives a breaker, right? Price gets all the way into the fair value gap that is here. So what I'm going to do now is I'm going to re-enter on this fair value gap level that is here, and I will put the stop all the way here because this level is acting as a breaker. So you actually saw me take a loss that would have been valid, and like I said, you have to get used to the idea of losing, which in the last section of this video I'm really going to key in on that. So we're going to place a market execution. We're going to confirm and see what happens now. So let's see how this pans out. ES is actually a better entry because it has not been retracing so deep inside, but NASDAQ is giving an entry right now, so we'll be in NASDAQ. So as you can see, ES did not get into the fair value gap to the breaker, but NASDAQ does. That's why we're in NASDAQ, right? When it comes to the breaker and fair value gap entry, you need to enter into the asset that gives you the actual entry. So that's why I'm in NASDAQ. As you can see, take profit was hit. We took a loss, and then we saw that the SMT was still valid. You're advised to cut down your risk on the next trade, right? You're advised to cut down your risk on the next trade, and you can see how that trade went in our direction. And the reason why the trade was not invalidated is because the low of Q2 in Dow Jones was not taken out, and that was rather just a manipulation. So this is the kind of price action that happens during low probability periods, and you have to get used to it. You're not doing anything wrong because you take a loss, right? You're not missing something that could have helped you to prevent taking a loss. This is just what happens, and we will get into that shortly. All right, so guys, I just want to put something really into perspective so that you guys can truly understand what trading is about. So in the section that you saw me trading, you saw me take a loss, and that is normal, okay? Taking a loss is 100% normal. The perception that's put out there, unfortunately, is that you're trading smart money, you're trading with the banks. So you are barely losing, you having like a 80, 90% strike rate. And folks, I'm here to tell you that no such thing exists, guys. It does not exist. No one has that strike rate. If I had a 90% strike rate, I might as well. That is like you telling me that I have a 100% strike rate, because at 90% strike rate, I wouldn't even be risking even 2% per trade. I'd be risking 10% per trade. If I was working at a job, I'd be risking my entire paycheck every single month. I don't care if I lose this month and I have to eat noodles the whole month. I have to move back in with my parents or something like that, because I know most likely the next month I'm going to hit. So having that kind of high strike rate is what is causing a lot of people to not be profitable. And I'm going to explain why. And I'm also going to prove to you why. You see, when you are trading and you lose a trade, or let's say you lose like 3 trades in a row, you don't have that high strike rate that is being promoted online. You think that you're doing something wrong. And what happens is that you go into the charts and try to study more. And in your studying, you may notice something new in the charts. And wow, this particular thing that I'm seeing in the charts is really working. Maybe I should start trading this. And you trade it for a while, it goes well. And then it too gets into its own losing period, and you start to lose. And now you think you are missing something, and you keep going in circles searching for that one strategy that wins more, because you don't want to be unrealistic and say, I'm looking for something that wins 100%. You're not that naive, but you are looking for something that wins more times than it loses, and a whole lot more times than it loses, like an 80% strike rate. Folks, this is an unrealistic mindset to have in trading, folks. It is not realistic. What you need to do is to plan your profitability on a low strike rate initially. When you begin trading, even if you have a 40% or 30% win rate for the month, there is no reason why you should not end the trading period in profit. Like for instance, in that video on Thursday, when I took a trade on Thursday, you saw me lose initially and re-enter, and it went in my direction. The way I normally trade, I wouldn't even re-enter. I would just leave it as it is, because if I'm losing, what that tells me is that the market is in low probability, right? So I would not even be re-entering or anything. I'll just take the L because I don't care. And I know that a period is going to come when I enter, place my stop loss, place my take profit, and price is just simply going to trade into my direction and hit my take profit, and it's not going to give me any hiccups. I know those days are going to come. So I don't care if I take a loss. I'm going to prove to you. And as you can see, guys, in this PDF over here, or this Excel spreadsheet over here, this is a trade simulator to show you what you can expect depending on your win rate. So over here, if you lose 1R, but over here, if you win 3R. And I put here a 50% win rate. Now, this is a simulated win rate. So sometimes you might see instances where you have a 50% win rate on average, but for a particular period, your win rate was like 50-something%, right? So let me put that in for you, and you will see. I put 50% again, it's 53%. I put another 50% again, it changes to 47%. I put 50% again, it changes to 48. So it fluctuates. So some periods you might have a 48% win rate. Some periods you might have 51, 53. It's not a straight line, and the losses do not come exactly as you expect. Like if you have a 50% win rate, you're not going to first get 50 wins and then 50 losses. They are going to come randomly distributed. Okay, so having this mindset of having a high win rate is what is holding you back. And I'm going to show you, because I said that if I had 90% accuracy, folks, I'm not going to even be risking 1-2%. I'm going to be risking damn near 10% per trade. And I'm going to show you. Let's say I put in 90% win rate, right? And I'm going to be risking 10% per trade, because 90% win rate, seriously, right now. Look at the equity curve over here. If I have a 90% accuracy, can you see how in just 1 year you've turned this amount into trillions? Into trillions, folks. Nobody has this win rate because they would be billionaires. Literally, I don't know if you know who Jadecap FX is, but Jadecap FX made the world record payout in Apex Trader Funding. And he did it off of just like 43% win rate. Where are all the people that have 80 and 90% win rate? Why aren't they breaking that record? because they don't have it. No one has this magic bullet. The realistic win rate that people have is like 50-55% win rate. A good month is like you have above 60%. There are months where it's so good that it goes 70-80%. You might even not lose a single trade that month. But on average, the win rate is usually like 50-something%. And I will explain to you why. We believe that the markets are controlled by an algorithm, right? Okay, that's what we believe. But just because the market is controlled by an algorithm, it doesn't mean that the results are not random. The algorithm sometimes will prioritize another trading model over your own trading model. And that aspect of the algorithm is random. So this mindset that there is some magic trading model that the algorithm is only going to prioritize 100% or 90-something% of the time, it's unlikely. And if such a model actually does exist, guess what? The trade frequency of that particular model is probably going to be so low. Imagine waiting a whole month to take just one trade for that month. And imagine when that trade showed up, you were not even in front of your computer. Why would you want to limit yourself to that kind of trading method? Why? If a 90% model exists, the trade frequency is going to be so low that you would literally make more money trading a 50-something% strike rate model. You would make more money trading that than trading that 90%. And even if a 90% model does, even if a 90% strike rate model does exist and it has a good trade frequency, I guarantee you the risk reward is so pathetic that one losing trade will wipe out all the string of losses. If it sounds too good to be true, it is too good to be true, folks. Believe me when I tell you that 50% win rate is more than enough. If you want to be profitable in trading, you better get used to the idea of losing a lot. A lot. Because if you can't do that, you're never going to be profitable. A lot of you could have been profitable a long time ago had you just kept this in mind. When I take a trade, this is something that I disagree with ICT, and I see that I'm in a losing streak, I don't cut down my risk. Because why would I cut down my risk and ruin my statistical edge? Because if I finally do win a trade, that one winning trade will wipe out many strings of losses. If I have another winning trade, it could potentially get me back at break even and into profit. What you should do if you are in a losing streak is to reduce the amount of trades you're taking and only focus on high probability trades, folks. Nobody has 90% strike rate. I only see online these trading gurus or smart money traders. They like to speak in parables and act like they're prophets. When time is aligned, that is when price will move. Acting like they're some prophet or something, like they have some hidden secret. And all that, folks, is just marketing. It's cringe when I see it because I know that no such thing exists, but I know it's working on people that are watching them. If I could just join this guy's mentorship, he's going to teach me that one secret thing that is going to change my trading, and I'm going to be winning like 80% of the time, and I'm going to be part of that special crowd that is winning most of the time. Such a thing does not exist, and if it does exist, they're not going to be out there teaching it to you. They're going to be keeping it to themselves. Why would I have a strike rate of 90% and divulge that? I just showed you that if I had that win rate, I could literally be a billionaire, trillionaire. Nobody has it, folks. Get your mind back to reality. This right here will change your life.